We've talked before about stable coins and some of the risks. We tend to talk about consumer protection or macroprudential concerns, but you have yet another concern you've written about in a Brookings paper. Tell us about the possible national security implications of stablecoins.
Sure. Well, the issue is that stablecoins can be transferred without going through banks, U.S. banks in particular. They're transferred on decentralized, permissionless blockchains. And it's really the role of U.S. banks in the global financial system that has given us the leverage to apply financial sanctions as a tool of foreign policy. Now, you can debate when and where we should be using sanctions. But if we want to still have that in our toolkit, it's important to think about the implications of stablecoins, and it's important to address how they're transferred and to figure out ways to make sure illicit activity isn't happening. We saw a recent report that Russian smugglers were in fact using Tether to finance weapons purchases, and there have been concerns that Hamas was using stablecoins to fund its activities. The market is still small, but it's important that we act now. And that may mean coming up with different approaches than we've traditionally used with banks and other financial intermediaries.
And with that in mind, you think about the national security concerns. What should regulation look like? Because when it comes to, what you were talking about, some of those examples, particularly when it comes to Russia, I would imagine that sort of bumps stablecoin regulation higher on the priority list.
Right. Well, the one good thing about blockchains, of course, is that there's a record. You can always see how things were transferred. But, that's useful after the fact. What we need to be doing is figuring out ways in real time to make sure these things aren't being used for illicit activity. That means requiring stablecoin issuers not only to apply the kinds of anti-money laundering protections that banks do, but also to engage in active monitoring of what's going on with their stablecoins, to have the ability and the willingness to freeze stablecoins. If they identify a suspicious wallet or suspicious activity, they can actually freeze those stablecoins and prevent them from being used. So that's one solution also. And also looking at what we call decentralized digital identity solutions, so that transactions with stablecoins can't even be made if someone's identity hasn't been sort of verified in advance. Now, that technology is new, may not be ready for market yet, but that's the kind of thing we need to be thinking about.
Tim, assuming for the moment the U.S. actually did implement legislation to do this, do we have the leverage over the issuers of stablecoin that we would need? You compared stablecoins to Eurodollars in your Brookings piece.
Yeah.
And that was different because sooner or later it had to go through the U.S. payment system. And clearly the U.S. government had power over that. Does it have power over these issuers of stablecoins?
Well, it does, because ultimately a stablecoin, and I'm talking about stablecoins that are based on the U.S. dollar, those have to have access at some point to the U.S. financial system. If people thought that Tether ultimately can't be converted into U.S. dollars because Tether was completely blocked out of the U.S. financial system, Tether would not have the value of $1, right? So we do have that ultimate leverage. We just have to think about how to use it. And the comparison with Eurodollars that I make is, Eurodollars started out small too. And U.S. regulators kind of were a little concerned, but sort of ignored the market because it was small. But they grew from unexpected events. It turned out well, in a sense, because they helped cement the role of the dollar. But we can't expect that necessarily with stablecoins.
And like you mentioned, we're talking about dollar-backed stablecoins here. When it comes to talking about potential regulation, legislation, what that might look like, should there be a distinction drawn between those reserve-backed stablecoins and algorithmic stablecoins, for example?
Absolutely. I think the algorithmic ones are far more dangerous. And I think the legislative initiatives that we've seen are really focused on the dollar-backed ones. And I think there's a lot of good measures in both the Lummis-Gillibrand proposal as well as Patrick McHenry's proposal in terms of these sorts of prudential requirements. We just need to remember that other countries are creating these frameworks too, And you could even have dollar-based stablecoins issued under those other countries' frameworks. That's why it's important for the U.S. to move forward. You know, it's also important because we don't just want to stumble into this digital future. You know, we want to figure out what do we need to do to really take full advantage of the digital future in finance and to also make it fair. You know, things like payments, frankly, for those of us that have credit cards and mobile banking, you know, it may seem to work pretty well, but our system is actually, it costs more, it's slower than what it could be, and that hurts low-income people in particular.
So, Tim, you mentioned a couple of pieces of legislation pending on Capitol Hill right now, one with Loomis and Gillibrand, another with Congressman McHenry. Are they listening to you? Is there any prospect for having some of the suggestions you're suggesting with respect to national security introduced? Because as I followed it, it sounds more about consumer protection and macro-prudential concerns.
No, I think they are. And I think others on Capitol Hill, you know, Senators Warren and Sherman have introduced a measure. Now, that would basically try to impose the framework we have for traditional intermediaries on a lot of crypto actors. I'm not sure that's the best way to go, but I think they're raising the right concerns. So, you know, I think these issues, more and more people are waking up to the importance of this.